All right, let's take a quick check of the markets. Well, Sensex is up about 500 points. So yes, the bulls have taken the markets to a very high point at this point of time. Nifty is above that 2350 mark that we were eyeing out for. So yes, quite a good start for the markets for today also, despite the weekly expiry on the Nifty 50. Nifty Pharma Index, however, is seeing a little bit of a profit booking with about flat in the red at this point of time. Nifty Auto Index still doing well, about with more than 0.5% gains coming in. Nifty IT Index seeing a good turnaround after the Federal Reserve keeping the interest rates unchanged. 2% gains coming in for the IT Index. If you look at some of the other indices, Nifty FMCG also flat in the trade at this point of time. Nifty Media Index with about 3% gains. Nifty Private Banks with about 0.4% gain at this point of time. And mid-cap and small-cap indices, both of them doing well. Small caps especially outperforming the markets with about 1.5% gains. But let's move on and get on board with our market expert of the show. Joining me, Sunil Subramaniam. Sunil sir, good morning. So good to have you.
Good morning.
I want to understand, we're seeing a bit of a turnaround, but do you expect the fundamentals to support this, or is this just a technical rebound or recovery that we are seeing given we had a 15% correction from the peaks?
So see, to some extent that's technical, and when I say technical, I'm saying that a lot of the charts, the moving averages, are indicating the time for a buy-up, right? But actually, it's the domestic DIIs, the DMFs, the insurance companies, it's their action. Now, when they do action, they don't rely on technicals. So while the rally looks technical, right, I think it's fundamentally a stock picking done by the domestic mutual funds and insurance companies because A, the correction. B, I think that from a perspective of the economy, I think a lot of the bad news, so to speak, has been in the market. So now, for a breakout properly, you would probably wait for the April earnings season. But before that itself, the degree of correction means that sectors where they don't expect a further correction are where they are starting to buy. I think DIs are flush with cash and they will lead this rally for the next few weeks. On the FII front, I think it's still early days to say in terms of whether they will come back to India. I think there are a lot of positive signals which we can maybe talk a bit later in the show. But I think that the initial part of this rally is going to be led by domestic investors.
Okay, all right. But what narrative could set the tone for the markets? Could it be earnings? Could it be the reciprocal tariffs, which is due from next month onwards, or do you believe the cooling dollar index and crude prices to play a good role for India?
So I think that all of them, but in terms of relative importance, I would place, since I said domestic fund managers are going to drive the next phase of the rally, it is the earnings season, which is the top of the grid, right? As far as the reciprocal tariff, I think a market has discounted the uncertainty. They all know something's going to happen. So I think for the short term, sectors which are likely to get affected by the reciprocal tariffs are going to be not in demand from a domestic fund manager perspective. You mentioned the easing dollar index. That's turned positive for us from a FII inflow perspective because with the Fed policy yesterday and two interest rate cuts being baked in and the fact that they have downgraded the growth forecast, from that means that the dollar is unlikely to strengthen. So that's a big positive for FI flows to come in. The second positive for FI flows would be, I think, a stable oil price. And I think it's hovering, Brent is hovering around 70, 71. But if the indicators come in terms of heading towards a 60-50 level due to Trump's drill baby drill actions and all of that, that's a second positive for India. So these two positives are there. But for FIs to make a decisive move yet, right, I don't think this is enough. They are good ticks. They would also wait for the earnings season to see whether the Indian growth story is 6.5% growth rate, which the IMF is projecting, is that on track or not. So I would say that the most important thing is the earnings season. So April is the period to watch out for.
Okay, all right, earnings season. But Sunil sir, what about, given that the FIs were waiting for the valuations to cool off for India, now that we have seen about 15% correction for Nifty from the peaks itself, so what do you make sense, like how the markets are going to react now that we are approaching the Q4 earnings season? What is your expectations? What can India Inc. achieve on an earnings growth front?
So I think that I would expect that from a future guidance perspective. See, this quarter's earnings are not so relevant because it's a completed year, and I think whatever happens, it's the guidance for the next year. And I do expect that at the Nifty and the large cap level, they should guide for a 12 to 15% EPS growth for the next financial year, which is 25-26. And I think if that comes through, the market will be happy, right? If it comes into the high single digits, the market may be disappointed. So I think a reasonably low double digit at the large cap space. The mid and small caps obviously will have to show a much higher growth path given the fact they are still at a premium to the large cap index. But I think those will play out more over the period of the year. It's very early days in April itself to take a good call on the mid cap earnings growth, but large cap definitely 12 to 15% I think would be the market expectation.
Okay, okay. But Sunil sir, now you're saying that mid cap and small cap still at a premium at this point of time. Any value that you're finding in the space, or should investors completely stay cautious of the broader end of the markets?
So I would say that see, the correction that's happened was because there was a momentum based rally, and I think that's now history. It's now going to be a quality rally, right? So in the mid cap and small cap space, I still think that good quality companies with the correction that's happened are good buys. But thing is, how do you define this quality? The quality is that you should deliver to what you say that you will get, right? Uncertainty is what detracts the people. So in the mid and small cap, I would back companies which have a relative certainty on whatever earnings, even if they are not the best earnings, there should be a certainty in delivery of those earnings. That's number one. Number two is in the short run, it's better to stay away from internationally focused sectors, right? For the simple reason that the Trump reciprocal tariffs, how they're going to impact it. If Trump goes through with his tariffs with the other countries, they may try to dump products into India. So I would say both the import and export related sectors, there will be uncertainty. So this market price correction may sustain a little bit longer. Whereas if you take a domestic place, right, even mid and small cap, within mid cap, the banks and financial services institutions, some level of the cap goods play, which are not so externally oriented, I do expect that the government capex program in a muted way will continue in the next year, and there should be a flow there. So I think it's going to be extremely stock pick and domestic growth centered. International related mid and small caps, I would still say there will be uncertainty, and it's probably better not to step into that territory yet.
Okay, okay. Sunil sir, everyone is banking on banks to lead the market recovery from here on. What do you expect, or what is this what does this hope mean for the BFSI sector? And apart from BFSI sector, you mentioned about export oriented themes that one need to be little cautious about. Any other themes that you are finding that people should be staying away from?
Okay, the first part of your question on the banking sector, the reason I continue to be bullish on that is because, see, from April, this 100,000 crores of tax giveaway is going to flow through into the economy, right? That's a given. Now, where will that play out? It will play out either in terms of consumption, which is at a consumer staples level, where urban consumption has been lagging. This might give a boost to that. Number one. Number two is that it will give a boost to consumer discretionary, because what people do with the income is probably take on a larger EMI burden to take on to buy the bigger house or a bigger car, right? So that's the second part, right? Now the third part would be savings and investments, where some people will not necessarily spend everything, but will save it. So I see that the banks are in a very good position to capture both ends of this 1 lakh crore giveaway, right? Both in terms of higher borrowing, which will happen because of the higher EMI capability that investors will have, plus the fact that savings and investments, all banks are now leading distributors of insurance and mutual fund products, and they will get their inflows into the counters there. So that's why I feel that from coming April onwards, there is a little bit certain other thing for banks and financial services, which is a very good indicator, is a slowing food inflation, which means that RBI's the expectation of a rate cut are probably higher, and banks naturally are the first of the block. The third is the proactiveness of the RBI in liquidity management. Now you've seen the tax season come and go. The liquidity RBI through its rupee dollar swaps and pumping liquidity has ensured that there's no shortage of liquidity. Hence, transmission of rates will take place very easy. So these are the reasons that I'm bullish on the BFSI space. Naturally, quality dominates here. So I would still go for good quality private sector banks and good quality NBFCs and the top of the pile in terms of the PSU banking space, as well as I would say on the savings and investment side, wealth management and market infrastructure firms are also good. Now you ask me which else should you avoid in this context of the international thing, right? See, I think IT's had a good run up. If the US is stepping into a slowdown and with the dollar no longer strengthening, right, the rupee depreciation, thing which was supporting the IT pack is probably going to be less. So to some extent, booking profits in IT is a decent bet. Similarly, within pharma, I would say the export side of the pharma will be still challenged. A, because of the slowdown in the US, but also because any dumping related will mean that China will be at par in dumping it. And in the EPA space, China is a dominant player. But in the pharma, the domestic hospitals diagnostics are still looking good. So you need to separate out pharma there. So I would still say stay away from the export side of pharma.
Okay, okay. Sunil sir, what about the defense and railway stocks? Because those were the one pockets that were always in the limelight. But do you believe that the valuations have turned attractive for both of these segments, or how should one investors approach this?
See, the valuations have corrected sharply, but the call on whether they are turned attractive is on the future business growth, not we're looking back at the past to see how much correction has happened. And there's a reason for that correction. One is, of course, they were part of a momentum-based rally and an original value to growth phase which they went through. But today, if you look at it, government has slowed down its capex budget. Over the last 4-5 years, they spent a lot on railways. Do they have the ability to spend even more on railways? I have my doubts. So I think that railways cannot sustain this growth path which the last few years showed. Defense is a different mixed story. I think some of the good quality defense PSUs have corrected a lot and they look to be decent value buys. But overall on the defense, we got to remember that Europe is probably going to go big on defense given what's happening between Trump and NATO and all of that. So there's going to be a lot of, but I don't think India is yet a big player in the export to defense. Second is, if we are going to do a deal with Mr. Trump, right, we will have to buy some high quality defense equipment from him. Now, if that means are they substituting some local suppliers? One. Two, however, if that could be managed well, you could see a 30% domestic content come in whenever we buy from the US. They'll come set up factories and they'll source locally. So that could mean a good mid and small cap defense supplier companies getting business. So I think defense is an interesting play and I would hold on to my holdings there and wait and see how over the next 3 to 4 months this whole international scenario plans out. And then I would look at buying stuff in defense then.
Okay, okay. Sunil sir, just one last question before we let you go. How about the metals in the cement space? Because they're receiving a lot of traction at this point of time, and even with China's announcing stimulus measures for their economy, the metal space has turned completely attractive. In the past 1 month itself, Nifty Metal Index has been an outlier compared to the overall market.
Because metals are a part of global cyclicals, right? And in global cyclicals, they are rate sensitive. So any Fed rate cut talks, and those kind of easing situation are good. And second is like China stimulus, if it leads to a good jump in metal demand, that's good. And for domestic companies, right, for India, right, see, steel and cement, you mentioned both cement also there, are closely linked to the capex cycle, right? That's where in concrete you need both cement and steel. And I think while the government has slowed down compared to the previous rates of growth, there's still about 10 odd lakh crores of capex going to be spent today. And I think the cement sector will benefit from that. So I think both cement and steel from an Indian perspective, I think will be good buys from that point of view because of the global impact of what's happening as well as the domestic demand. So I'm positive on metals in the commodity space at this point in time.
Okay, all right. With that, we have to let you go, Sunil sir. But thank you so much for your time and hope that we connect with you soon.
Thank you.